Okay, if a financial product locks your money for 20 years, gives you returns barely higher than a savings account, and still calls itself an investment, that's not a plan. That's a very expensive FD wearing a life insurance mask. And in India, that mask is usually called an endowment plan. Hello folks, I'm Shashank from Ditto Insurance, and today we're going to break down what an endowment plan really is, why it's sold so aggressively, where it actually fits, and when you should politely say no and walk away. And if at any point you're like, boss, just tell me what I personally should do, you can always book a free call with Ditto's advisors for a spam-free experience. Our services are completely free. Book a call with the link in the description and we look at your policies one by one. Alright, so let's start simple. What is an endowment plan in life insurance? Now, think of it as a combo. Part life insurance, part long-term savings plan. You pay premiums every year. If you die during the term, your nominee gets the sum assured. If you survive till the end, you get a lump sum back. Usually the sum assured plus some bonuses if it's a participating plan. Okay, for example, you buy a 20-year endowment policy with a sum assured of 10 lakhs. If you pass away anytime in those 20 years, your family gets 10 lakhs. If you survive the full term, you get a maturity amount which could be the 10 lakh plus bonuses declared over the years. Now, on paper, this sounds perfect. You get protection, you get money back, and it all feels safe and guaranteed. The problem is in the fine print. Typical participating endowment plans in India generate around 4 to 6% per annum over the long term. Now, inflation itself hovers around that 6% mark. That means after 15 to 25 years, the guaranteed return that you're so proud of may actually have lost purchasing power. Now, you will definitely get a check, but what it can buy in the future versus what you put in today is where the real story lies. Now, you may have seen some fancy jargon like full endowment, low-cost endowment, unitized with profit, non-profit endowment, and so on. Now, most of that is imported British actuarial language that doesn't really map cleanly to how the Indian market is regulated today. In reality, if you take a look at IRDAI's own framework and how Indian insurers design products, you can think of endowment plans falling into 4 practical buckets. First is the non-linked participating endowment. This is your classic with profits plan. Non-linked simply means that the money is not invested directly in the markets. Participating means you share in insurers' profits via bonuses. The company declares bonuses every year, and once they are attached to your policy, they become guaranteed. You don't see wild equity style swings, but your final corpus depends on how well the insurer's participating fund does. This is for people who want steady, slightly boring long-term savings with a bit of upside and really don't care about tracking NAVs and indices. Now, the second bucket is the non-linked, non-participating endowment, also called guaranteed return plans. Again, no market exposure, but here you don't get any bonuses. The insurer gives you a neat benefit illustration at the start which spells out your guaranteed maturity amount, your premium schedule, and the policy value at each stage. Now, there is no we'll see what bonus we'll declare later. What you see is what you get. This suits people who like predictability, something that feels like a long-term FD but with a life cover stapled on top. Third is the non-linked variable endowment. Now, this is a bit of a middle path. Your money is not in the stock market, but the returns can vary within a band. There is usually a minimum guaranteed component, and above that, the insurer may credit extra amounts depending on how their internal fund performs. Here, you're not taking the full market risk, but you are allowing some movement in returns. These products exist, but they aren't very popular because ULIPs stole most of the semi-flexible space. Now, coming to that, ULIP comes under linked endowment, which is where your money goes into equity or debt funds and your maturity value depends purely on market performance. There is no guaranteed maturity amount unless the product specifically builds in a floor. Now, you still get life cover plus a maturity benefit, so IRDAI classifies them in the same broader category. But in common language, people just call them ULIPs and not linked endowment. Now, before we go deeper, if you already have an endowment policy or ULIP and you're not sure which type it is, then that's a problem. You can book a free call with Ditto's advisors for a spam-free experience. Our services are completely free. Okay, now let's talk about why people are attracted to endowment plans in the first place. The first benefit is forced savings. You commit to a premium for 15, 20 something years and you can't casually stop shop or redeem like a mutual fund SIP without penalty. For many people who lack discipline, that forced structure actually helps them build some corpus. The second benefit is the dual advantage of insurance plus maturity benefit. If something does happen to your family, gets money. If you survive, you get money. So psychologically, it feels better than a term plan where nothing comes back if you live. Third, there are tax benefits. Under the old regime, your premium can get deductions under Section 80C up to 1.5 lakh per year, and if conditions are met. The maturity proceeds may be tax-free under Section 10D. Now, new rules from Budget 2023 do change things for high premium policies. If your annual premium across certain traditional plans is above 5 lakh, maturity amounts can become taxable. Death benefit stays still tax-free. There's also the comfort of lower risk in the non-linked versions. If you hate seeing your investment fluctuate, or an endowment plan actually feels calmer compared to watching an equity fund jump around every single day. The price that you pay for that calm though is low real returns. Another thing that people don't quite understand is what happens if they can't keep paying. Now, under older rules, if you stop paying in the first year, the policy would pretty much die and you get nothing. Now, under the IDI norms, even if you've paid just 1 year's premium, you are usually eligible for some special surrender value, which will be shown in your benefit illustration. If you pay for a couple of years and then stop, many plans convert into a paid-up policy. Now, that means your life cover continues but reduces in proportion to how much you actually paid versus what was originally planned. Your maturity benefit also reduces and you don't have to pay any more premiums. You're not optimizing returns, but you're at least not getting completely zeroed out. Now, let's park endowments for a second and compare them with other two big life insurance buckets: term plans and ULIPs. See, a term plan is simple. It's a pure risk cover. You pay a small premium and you get a huge sum assured, and there is no maturity benefit unless you add an expensive return of premium feature. A ULIP is risk plus investment but more market linked. You pay premiums, part goes to your life cover and part goes to your funds, and your maturity is just the fund value. An endowment sits in the middle as a protection plus savings with fixed or bonus based returns and limited or no market exposure. But here's the uncomfortable truth: endowment plans are among the most missold products in India because they pay fat commissions, and I'm not kidding. In some cases, 30 to 50% of your first year premium can go towards distributor commission and expenses. Compared to that, term plans pay much lower commissions. So what happens in the real world? Instead of saying buy a term plan for protection and use mutual funds or FDs for investment, many agents push one big endowment policy with a sales line like guaranteed maturity, tax-free, no risk, best of both worlds. On paper, sure. In practice, you lock yourself into a low-yielding long-term structure that quietly loses to inflation. Now, if your real goal is to protect your family's finances if you die early, a term plan does that far more efficiently by giving you large cover for small premiums. If your goal is long-term wealth creation, mutual funds or even a well-chosen basket of other instruments typically beat endowment returns over 20 years. Endowment plans start to look sensible only for someone who's extremely conservative, wants predictability above all else, is okay with low returns, and genuinely appreciates the forced savings element more than growth. Now, if you're confused right now whether your next rupee should go into term, an endowment, or a ULIP, don't guess. You can book a free call with Ditto's advisors for a spam-free experience. Our services are completely free. The link is in the description. Alright folks, that was it from me in this video. I'll see you in the next one. Until then, happy insurance hunting.